Thank you very much for joining. My name is Darren Joseph from HCJ.tax. We're a team that seeks to demystify the sometimes confusing world of cross-border taxation. And today we have the honor and privilege of joining us, Claudia Vasconcelos. Please introduce yourself.
Well, thank you, Darren, first of all, for inviting me. It's a pleasure to be here, and thank you for the opportunity to discuss and explain the advantages of investing and living in Madeira. This is a topic that is very dear to me. I'm born and raised on the islands. I am currently head of business development of NewCo. We are a one-stop shop for investors and expatriates in Portugal. We're headquartered in Madeira. And most of my career has been dedicated and devoted to the attraction of foreign investments to Portugal, specifically to Madeira, or mostly in particular to Madeira. I've actually worked for about 18 years in the entity that is still today the government entity in charge of promoting the International Business Center of Madeira. And for the past 10 years, I joined NewCo, and we are actively promoting and assisting investors and expats relocating in Portugal, and particularly in Madeira.
Thank you very much. I appreciate that.
Thank you.
So let's compare, if maybe this may be a bit uncomfortable, because I know that your company operates in both of these jurisdictions. I want to talk about Madeira versus Malta. Mm-hmm. Because it sounds as if, to some extent, the offerings or the incentives in Madeira are similar, not exactly, obviously, but quite similar to what exists in Malta. What are your comments and what are your thoughts on that?
It's not uncomfortable because I'm asked by clients ask me that all the time.
Oh, okay, good.
So our role is, although we operate, we have a physical office, and we assist clients implementing companies and managing their companies in both jurisdictions. It's a case-by-case basis. Yeah. So although in the end, the corporate income tax rate is 5%, and they both offer very good tax incentives also for the shareholders. In practice, the tax structure is different. So in the case of Madeira, it's a nominal tax rate. In the case of Malta, it's an effective tax rate. And this already makes a difference in terms of the operation of the company. But most important, I would say, is the activity, the nature of the activity, the markets where the company will operate, and the economic reasoning also, because let's us not forget that the motivation, as much as possible, should be economically driven, not just tax driven. And this makes a difference for our clients. So we want, depending on where your clients are based, where the language is based, the language has an impact, the talent base as well, the markets of operation, and of course the activities. Some activities are not, for example, financial activities, or companies that are more, that have, whereby the financial, if you have investments, financial investments, not necessarily regulated, but if the company's income has a good percentage of financial investments, then in Madeira it doesn't make sense. And it does not make sense. It does not make sense. Okay. Doesn't work. Whereas in Malta, it can be very competitive in that case. So we always try to understand on a case-by-case basis what the client is looking for, what are the motivations, what will be the requirements in terms of substance, the relationship with both countries. Malta, for instance, has the network of double tax treaties that is wide, as well as Portugal, but is quite different from Portugal. Portugal has a very good treaty network with Portuguese-speaking countries, of course, Spanish-speaking countries, and Malta in that case does not, but has Asia and the Middle East. So it depends. It's something that we have to look into with a broader perspective, and on a case-by-case basis. Both are competitive, of course.
Okay, yeah. So I get that. It depends on the jurisdictions involved. It depends on the nature of the activity. But let's go back to that whole thing about passive investment. So, like, for example, if it is, I have, 7 or 8 figure investment portfolio in the US, publicly traded, privately held, or whatever. And of course, depending on the European country that I want to live in, it may be taxed it may be taxed from my point of view inefficiently. And I may want to set up, let's say I want to set up a family office, a small family office, someone to take care of the admin and do the day-to-day stuff while I just enjoy life. I can look at either Malta or Madeira, potentially. But of course, as you kind of hinted initially, the Maltese regime is an effective rate. So I pay the headline
and then you get a refund.
And it takes
and
a while to get a refund.
Yes, it takes a while. So that's also one of the reasons that we have to see on a case-by-case basis, because in the case of Malta, it's important to consider that first, the shareholder is the one who gets the refund, not the company. So you either have a double tier structure in Malta, or the shareholder must be resident in a friendly tax jurisdiction. Otherwise, and because to get the refund, you have to apply for it every year. So the company has to submit the tax returns, pay the tax, and then apply for, and then the shareholder applies for the refund. And this may not be efficient, not only not necessarily from a tax perspective, but from a practical liquidity perspective.
Absolutely. So let's say I'm living in Spain or France. Then potentially an option for me would be to set up my very small family office in Madeira as opposed to Malta. And
it depends on if the main income of the company results from a portfolio of investments. Then it will not work.
It won't work. Okay.
It wouldn't work, because it would be considered not a financial regulated entity, but there's no operational entity in our perspective. So the difference is that Malta doesn't consider the passive in Portugal. Passive income is defined very clearly, while in Malta, a portfolio investment could be considered active income and not necessarily passive. So this is what triggers the difference of the tax rates. The interpretation of the nature of the income is different. Of course, it's not necessarily the fact that you have a portfolio investment that will allow you to qualify as active income. It depends on the frequency. It must be seen and considered as an active business of the company. And if that happens, you have access to the special tax rates, and there are criteria for that. In the case of Madeira, if there is you can invest in a portfolio, but for the use of excess cash flows of the company. But this implies that there is another main core business activity of the company.
Okay, and so it must be actively trading.
Yes.
So for example, there must be portfolio rebalancing. There must be some sort of activity as opposed to just sitting back and I got you.
And the investment portfolio is only as an ancillary activity of the company, that because you've excess cash flows, you're able to use it for the company's advantage. But it mustn't be the main activity or income generating activity for the company.
Okay.
That's one of the criteria, but there are. There are others.
So the Malta versus Madeira could be interesting, but it would be, case by case, rigorous analysis would be required to make that determination. Okay.
And again, we must always look from an economic motivation.
Of course. Principal purpose test. Exactly.
Yes.
Okay.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.